Back to business entity concept. What does this concept say? Business entity. Business entity. We call this concept owner to business entity concept. Why am I saying owner to business entity concept? This concept is saying that when it comes to treatment of transactions in the financial statement, we have two things at work here. Remember, a business coming into existence where we have what? One person who started the business, start the business by what? Introducing his own capital in the business. And later, because the business has grown in size, he decided that he can't run the business by himself. He needs to get other people to do the running of the business for him or her. And that will result in what we call management. So in business, management are a group of people who are involved in the day-to-day running of the business by the investors of such business. So business ethics concept is saying that when it comes to recognition of transactions, there are two parties at work here. We have the owners or the investors, and we have what? Management. So any transaction that have a reflection about the owners or the investors should not be included as part of the business transaction. So shall any transaction or effect that has an effect with what the business itself, which is being run by the management, should not also be what? Included in the affairs of what? That of what? The owners or the investors. So in summary, the business stand on its own, and then the owners also stand on their own. That's why when you have a business and you go and register to it, at that point, you are an investor to the business. The business stand on its own as an artificial person, and you also stand on your own as a natural person. So should in case there should be any kind of misunderstanding between you and then the management, because the artificial person here is the management that runs the business, right? So should in case there should be any misunderstanding about how certain funds are used in the business here and there, the business stand on its own to send the investors or the owners to court. So is also true for what? That of the owners. Should in case the business, they are running a certain, taking certain investment activity which is not, in line with the, with what owners seeks to achieve at the end of the day, then owners too can also send the business court. This is what we call business entity concept. So under this concept, the owners have the right to sue the business. So shall the business also has the right to sue the owner. So to be sued and to be what? Sued. That's the concept of business entity concept. So here, transactions are recognized separately. We don't mix the affairs of the owner to that of the business. So shall we also don't mix the affairs of the business in terms of transaction to that of what? The owners. All right? So that is the idea about the business entity concept. Two parties at work here. The business itself as an artificial person, and the investor or the owner also standing as a natural person. And then they interact. So once your business is registered, then it's attained what we call legal status. Legal status. We call it legal status. Legal status of that artificial kind of person that the business actually stands for. And this is what we call the business entity concept. Back to the next one, historical cost concept. Historical cost concept. The idea here is that when we say something historical, we're talking about past or previous information or an idea. So historical cost concept is saying that when it comes to recognizing of what? Transaction, their value in the financial statement is supposed to be recognized based on their true cost or their original cost that the item was bought or purchased. Are you following that? Yes. So when it comes to historical cost, accountants are advised to record the original value of the transaction that the item was bought or purchased in the financial statement. For instance, let me give a practical example. Let's say, the accountant of the business went to town to, let's say, buy stationeries. These pens, markers, office pins, those ones. And he or she bought that amount for, let's say $100. $100. That was why he bought it in, let's say, 6 months ago. 6 months ago. In the year that we're preparing our financial statement, under historical cost concept, we expected that the accountant is supposed to record what? The original cost of these stationeries in the books rather than the current cost. right? This is what we call historical cost. That transaction is recognized in terms of their value, the original cost of the item, rather than any other cost. Hence, historical cost concept. The cost should be, the original cost should be what should be recognized in the books of the account. Back to money measurement concept. The name is what? Money measurement concept. If you could remember, in our discussion accounting, in the definition of accounting, we said that accounting is a process of what? Identifying, measuring, recording, and communicating of what? Economic events quantified in monetary terms. So under money measurement, it is saying that when it comes to recognizing of any transaction in the books of the account, or recognizing any transaction on the financial statement, right, we only recognize transactions that have a monetary substance. That's coming from the definition of accounting. We only recognize transactions that has what? A monetary substance. Other than that, you can't record anything on the financial statement, because everything and anything on the financial statement has a monetary value. Has a monetary value. So all transactions that should be incorporated in the books of accounts, here the financial statement should have what? A monetary substance. Hence what? The money measurement. So you are talking about what? Monetary substance. Monetary substance. So for instance, let's say your manager, or let's say the CEO, you are the accountant, and he came to you that, accountant, there is this employee or this worker whose skill set, in this business is so, great that without him, we can't, we couldn't have gotten to where we are now. And as such, we need to find the value of his or her skills, and then let's award him something. When that manager comes, or that CEO comes to you as accountant and make that scenario, that case to you, what are you going to do? Are you going to say that, okay, because of that skill set that Mr. ABC or Mr. B has, you are going to add value to it and record in the books of accounts? When you do that, you are against this principle, because the skill set, the approach, or how he go about his work doesn't have any monetary value. So you're supposed not to record this on the financial statement. It go against what the money measurement. So anything that's supposed to be recorded should have a monetary substance. So you tell that your CEO or the manager that this is against a concept called money measurement, because all information that should be included in the financial statement should have a monetary substance. So the skill set, the attitude, the behavior that are adopted by staff in their work, which is so nice, doesn't have any monetary value, and so therefore is supposed not to be recorded on the financial statement or in the books of account. And hence, money measurement comes to time. We only record or recognize transaction that has a monetary substance. Hence, money measurement. Back to realization concept. This realization concept has a relation with what? Revenue generation. Revenue or sales. Revenue or sales. What is the idea about realization concept, or what? Revenue. This concept is saying that, okay, when it comes to revenue generation, right? When it comes to revenue generation, the idea here is that we only record revenue for which we have what? Earned. We only record sales or revenue for which what we have earned, for which cash has been paid for it. That is realization concept. So we can only recognize revenue in our books where there has been a transfer of what? Ownership from the seller to the customer. At that point, we can recognize what? Revenue. Whether the cash is paid for it or not. Once there is a transfer of ownership in the sense that there is transfer of that product, that good, that service from the seller to the customer, then we can recognize what? That revenue. It's what we call what? Realization concept. So here, revenue is recognized when there is transfer of ownership of that product from the seller to the business, and not when only cash is received or sales undertaking where there is what? Payment. But as and when there is a transfer of ownership from the seller to the customer of that service or that product, then we can recognize what? Revenue. So this has a part relation to the accrual concept under the revenue aspect, which says that we recognize revenue not only when cash is received, but as and when they occur, then we can recognize revenue. As and when there is a transfer of ownership of that product or that service from the seller to the customer, then realization concepts at work here. So take note that realization concept, we recognize revenue or recognize transactions that have what? A sale relation, which consists of what? Whether paid or there's a transfer of what? Ownership from the seller to what? The customer. That will lead us to what? A realization concept. Then back to materiality concept. One of the key issues when it comes to, relevance. One of the qualitative characteristics of the accounting information, relevance. Materiality concept is saying that when it comes to, preparation and presentation of financial statements, should in case there should be any value that we should incorporate it or we should record it in the financial statement, which can, in its effect, can have an influence in the decision that users of accounting information will make, then we are into what? Materiality concept. So we are saying that when it comes to materiality concept, care should be exercised on the value or the significance of the value that we recorded in the financial statement, should in case it can influence the decision that users of accounting information or users of economic information will actually make. So it says that materiality concept says that materiality says that if omission or misstatement of certain item can influence decision that users of accounting information will make, then such such decision or such recording should be well reviewed before even you undertake that. So you are looking out for the significance of the item that you are incorporating into the financial, the significant, whether it's significant or insignificant. If it has the effect of influencing users' decision, then it can be material or immaterial. Is that okay? For instance, let's say we sold some stocks to our customers for a particular period, all right? And let's say we sold, it was about, 100,000 Ghana cedis that we sold to our customers. Even though they have paid for it, but we have transferred, 50,000 of the value to them, we still have the 50,000 with us, even though they have paid for it. How, as an accountant, are you going to record this in the books of account? Even though they have paid the full amount of 100,000 Ghana cedis, but you have transferred just 50 to them, we still have the rest with us. So how are you going to account for it in terms of stocks, closing? So how are you going to account for it? So that means that the 50,000 is worth significant. So you can't include that 50,000 on your financial statement, knowing that the person has paid for it, and you are saying that still the stock is still in possession. No, when you do that, it has a significant effect on the decision that users will make. So you can't include that 50,000 to it. You must find a way of disclosing it that, hey, the customer has paid for it, and so therefore we can't include it as part of our closing stock for the period because it has been paid. And so therefore we'll have to disclose it. But in the form of as part of the note to the account, you disclose. So that is the concept of materiality. If any omission or misstatement can influence the decision that users will make as per the financial statement or accounting information, then such is what we call materiality concept. And the influence can be either material or immaterial. It can either be small or very big, depending on the significance or the nature of the value inclusion. So that is the concept of materiality. Then periodicity concept, per the name periodicity concept, you are talking about the period. Here we are talking about the period that it's been adopted in the preparation and presentation of financial statements. So periodicity concept is saying that when it comes to preparation and presentation of a world financial statement, it's supposed to be prepared within 12 months calendar, and it's supposed to be prepared at the end of the 12 months, or at the end of the reporting period. That's where you're supposed to prepare the financial statement. So when it comes to periodicity, businesses are expected to operate within the 12-month calendar, and we're supposed to prepare the financial statement covering all the activities that have a financial relation within the 12-month period. This is what we call periodicity concept, within the 12-month period. So that is the periodicity concept here. Then objectivity concept is also one aspect when it comes to preparation and presentation of financial statement. Here, accountants are advised not to bring in what we call their biases. I hope that spelling is right. Biases and then, subjectiveness. They're supposed to be objective in the preparation. They shouldn't bring in their own personal, influences to affect the financial statement. Else, it will turn the financial statement not being not being objective and verifiable. So your accountants are advised to, let go of their own personal opinions, their own biases, and their subjectiveness, and then being objective, right, in the preparation and presentation of the financial statement, so that to give clarity and meaning to, users of the accounting information. Then we have substance over form. When you say substance over form, it's also one of the aspects of the accounting course, which says that when it comes to recognizing transaction, let me give you a practical example. Right, that when it comes to recognizing transaction, for instance, let's say at a particular period, we realize that, let's use the example that we use on the space rent here and there, that the business has increased in size, customers are demanding a lot of their product, and as a result, they're supposed to produce in excess. But producing in excess means that they don't have the space to keep such stocks, and they went in for, a rent. And they, rent that space that they're going to keep those excess stocks that customers are demanding because of the market being so buoyant in that order. Okay, so substance over form is saying that since we have rented that apartment as part of our space we are going to use to keep our products, right? The whole idea here is that even though legally that space does not belong to us, but on economic wise, that space belongs to us. Let me take it again. Legally, that space does not belong to us. In terms of documents and other things, we don't have that ownership of that space. But economically, that space belongs to us. So let's say the legal cost, right? The legal cost of such space was, let's say, 10,000 US dollars. And we rented it for, let's say, 3 months, and we were paying what? We were paying, let's say, $4,000. So in terms of recognizing the true cost that we should record it as the space for the rent on our financial statement, which of that are you going to recognize? Even though currently we are the one using that space, are you going to record the legal cost of 10,000? Are you going to record the economic cost of what? 4,000. We are going to record what? The 4,000, because it is that period that we have paid for that value. So substance over form is saying that in recognizing transaction, the legal cost of the transaction is supposed not to be recorded, but rather we record the economic substance of that transaction. The value that we have paid for it, for which you are receiving the same value in service or in benefit, that's what we're supposed to be included in the financial statement. And this can be what we call a lease agreement, leasing. So rent, then we include that, the economic value we pay for the period that we're supposed to use for it, but you're going to include what? The legal value of it. This is what we call substance over form. That in recognized transaction, the substance of the transaction or the economic value of the transaction is supposed to be recorded on the financial statement rather than its legal form or legal cost or value. This is what we call substance over form. So in our space issue, we are going to record just the 4,000 as part of our assets in the asset group, the PPE, the asset group. We are going to record that as part of the lease, let's say lease agreement, space, rent, and record that 4,000. We're not going to record 10,000, because it doesn't belong to us. We just rented it for it. So that is the concept of substance. So any accountant who go the other way actually doesn't understand this concept. So that's what we call substance over form. That we recognize the economic substance of the transaction rather than its legal form in the financial statement. So that is the substance over form issue at work here. And then lastly, the duality concept. When we say something is dual, means what? Double, dual, double. So duality concept is saying that when it comes to recording of transactions, right, it's supposed to affect what? the boost word twice. That means you're supposed to have what we call a debit and supposed to have what we call what a credit. This will introduce what we call what the double entry principle. When we get there, we'll revisit this concept once again, right? The duality concept is saying that when it comes to recording of transactions, you're supposed to affect the boost twice. You're supposed to have a debit, supposed to have what a credit. For instance, let's say, we paid for what the item that we bought from Mr. Mensah. Purchases or item bought 10,000 from Mr. Mensah. So here, what is happening here? We have paid for what? Let's say 10,000 Ghana cedis for the item that we bought from Mr. Mensah. So in this case, Mr. Mensah is our supplier, right? And we are the business. We have paid for that what amount of that that stocks that we want to sell to our customers. So here, here's what we're going to do. Since you have paid for it, money is going out. The idea here is that money is what going out to Mr. Mensah. So we are going to credit that money account. We call it cash account because whether it's a cash or check that we use to pay for it, we credit that account. That, hey, if it's cash, cash is supposed to be credited. And then who is receiving the money? Mr. Mensah. So we debit what? Mr. Mensah what? Account. This is what we call what the duality concept. We will exploit this when we get to the double entry, the golden rule for recording of what business transactions so far as accounting is what concerned. So that is a duality concept that we're supposed to understand. That in recognizing of transactions, it's supposed to affect the boost twice. It's supposed to have a debit balance, supposed to have what a credit balance. And that is all that we're supposed to understand when it comes to the accounting concept and convention and the concept that we're supposed to know so far as the preparation of financial statement is concerned. So we learn this, or accountants are supposed to know this so that they can prepare the financial statement that give what a sense of purpose and what direction. Because as I said earlier, without these concepts and convention, if accountants are allowed to do their own or prepare their own what financial statement, there will be chaos because anybody in any field can present this or your own what financial statement, and that will affect the issue about comparison and the interpretation. Should in case we will need financial statement for formal records or formal activity to, let's say, undertake, let's say, a contract or something of that sort, it may affect it. That is why every accountant, every professional in the field of accountancy is supposed to understand these accounting concepts and conventions so that they can easily, understand them and then apply them in the preparation of the financials as per the IAS 8 accounting concept, policies, and then, I think errors or something of that sort that we're supposed to understand. But we are just looking at the basis. When we get to financial reporting, we'll get to some of these issues as one of the standards that are used in the preparation and presentation of the financial statement. So this is what we're supposed to understand when it comes to the accounting concept and conventions and the various accounting concepts that we have discussed so far. So this is what will bring an end to our discussion on accounting concept and convention. So thank you so much for watching this video. So in our next video, we are going to take a case study that will help us to be able to analyze these concepts. We are going to present a case study where there is, violation of these concepts so that we being, accountants or we being students of accounting, we can then apply them that, okay, it's supposed to be this, then evaluate this concept, evaluate that concept so that out of that we can have a better understanding about these concepts that we have gone through. So thank you so much for watching this video. If it was really helpful to you, please do all to like, subscribe, and then share. If today is your first time here, thank you so much for visiting us. This is a community of learners where we learn issues about business, mathematics, and then accounting. So thank you so much for visiting on this channel. And then I'll see you in the next session where we'll look out for a practical case study in explaining these concepts. For now, bye-bye.